Hey, everybody, I wanted to learn more about the bond market and how the bond market is important to interest rates. And we hear all those words about, yields and curves and all that kind of MBSs and stuff like that. So I kind of wanted to find somebody out there in the universe that really knows this stuff. And so I want to introduce you to my new friend, Troy Gayeski. He's coming to us from Connecticut, right, Troy?
That's correct. That's correct. A little further
Yeah.
north.
Yeah, and he's a MIT guy. I think he said he had like a chemical engineering degree, but he played football at MIT. Did y'all ever win any games, Troy?
We usually go 5-4, 4-5. It's not as good a football as you have at Georgia, but it was fun to play in the fall.
So they're all big engineering, IT smart guys, right? There are some of those big guys that are smart, right?
There are a few of us, although few and far between.
I love it. All right. So hey, Troy works for FS Investments, my good buddy Neil here in town, who's kind of my stockbroker buddy. I said, "Hey man, who's a smart guy on the bond?" So that's how I got to Troy. So Troy, I mean, let's just start off. Let's do this. I want to do it 101,
Yeah.
like we're talking to people that don't know hardly anything much about investments. And so I guess the first question is, what is a bond? How
Yeah,
would you explain that?
sure. I'm gonna keep my comments because I think it's easiest to understand the U.S. Treasury market. And every bond is linked to that to some extent. So effectively, what a bond is you're an investor that has cash. You're willing to lend it, but because you're not a bank, what you can do is purchase a bond that's been issued by someone that wants to borrow money, right? And in this case, it's the US government. I think everyone knows we run very large budget deficits, meaning tax inflows aren't as large as the money we spend every year. So the government has to finance itself by borrowing money from US citizens, in some cases banks, foreign entities. So they issue a bond, which is a contractual obligation for the US government to pay interest payments and eventually a principal payment at the end. If you look at a 10-year term, the 10-year treasury is one of the largest bond issuances around. For 10 years, the government has to make interest payments, say 4.5%. And then at the end of the 10 years, they have to pay you interest and principal back. And that ends the tenure or the term of that particular bond.
So that's why you have a 1 year, a 2 year, a 3 year, whatever, different lengths.
Mm-hmm.
Now, do the shorter ones pay more or the longer term ones? Is a 2 year more or a 10 year more?
It's a great question. So usually shorter dated treasuries or bonds of any kind, whether they're corporate or mortgage related, pay less the shorter they are and pay more the longer they are. And part of that is because there's more risk in lending for the long term. You don't know what's going to happen with the economy, with inflation. Um, that's fancy term known as a term premium. What's been very unusual about the last several years is the Fed funds rate rose so much that you got paid more to park your money in cash or to buy 1 or 2 year treasuries than if you purchased 10 or 30-year treasuries. So that's an unusual circumstance. It's correcting itself slowly as the Fed cuts rates and long dated yields go higher. And then back to your original question on what is a bond, another way of thinking about it is it's a loan, right? But instead of actually lending the government money, you're purchasing a bond and the proceeds are being used to finance their massive expenditures.
So I explain it sometimes. It's like a CD, right? You go to the
Yeah.
bank and you get a CD, and they pay different rates depending on if you're doing a 6 month CD or a 1 year CD, and you're going
Mhm.
to get a return on that CD. And the reason why the bank's paying you for that is they're then taking that money you're giving them, and that's the money that they lend out to their customers. And so they pay you, say, 5%, and they lend it out at 7.5, 8%. Is that sort of the same principle?
Yes, when front-ended yields are lower than longer dated yields. That's the principle. But one of the reasons banks have been under some pressure up until recently was when you do have this phenomenon of higher front end rates than lower long end rates, it makes them harder to lend at a higher rate on the money they're taking in through your CDs, your savings accounts, your checking accounts, et cetera.
Gotcha. Okay, so is that what you were explaining? Is that kind of what do we call that? It's not inverted, but when the short term is paying different than the long term.
Yeah, you're 100% right. It is called inverted. When you have higher short end rates, like CDs are paying you more than the 10-year treasury yield, that's an inverted yield curve. And normally, if you look at where the Fed has set the Fed funds rate, which in turn tends to set CD rates, there's about 100 to 150 basis point higher yield in 10-year term than there is in ultimate overnight term. And this cycle we got as low as 200 in the other direction. And, you know, one of the points we make to people quite often, whether they're looking to take out a mortgage or they're in the mortgage origination business, they're looking to buy a home or sell a home, is when the economy is expanding and the Fed is cutting rates, you often see the 10-year minus Fed funds or 10-year minus CD rate at 200, 300, even close to 400 basis points. So we really don't think, or 2, 3, 4%, meaning you to use your analogy, you give the bank money, they pay you 3, and then they lend it out at 6 or 7, right? Or that's usually how it works. And so we're not optimistic that interest rates, long dated interest rates, are going to go down. In fact, we think they're going to go up. And we're also not optimistic that mortgage rates are going to go down. We think they're could potentially go up.
We're going to talk about that in a second.
Yeah,
that's not good for me. All right. So, there are different kind of bonds, right? So there's the government or treasury bonds. What are the other kind of bonds that people can buy?
Yeah. So the second largest mortgage, or sorry, I should say bond market in the world, is the U.S. agency mortgage market. Most folks have some familiarity with this because of what those agencies went through in the global financial crisis, where they were doing a lot of dumb loans. You could blame the government or not, but there was a lot of silly behavior going on. And they were basically insolvent. And so they needed multiple government bailouts. But to make a long story short, the way the U.S. residential housing market works is the principal financier of that are U.S. agency mortgage bonds. It's an $11 trillion market. To put that in perspective, the U.S. Treasury market, we've been borrowing a lot of money for a while, you may be aware of, is $29 trillion. Not so long ago, the U.S. agency market was larger than the Treasury market. We've been issuing so many treasuries, it's really, this issuance has skyrocketed. So most of the financing for the average home buyer ends up in an agency RMBS bond. What doesn't end up there is typically held on a bank balance sheet, particularly jumbo loans, larger loans. And there's also a small little market that serves people that have weaker FICO scores, mainly because they own their own business. They don't have credit history.
Subprime type market.
Yeah. So they really call it, what's the term? It's not a
QM. Non-QM.
Non-QM. That's 100% right. Non-QM. And, you know, subprime has some very negative connotations from what happened when, as you know, from your business, underwriting standards were terrible pre-crisis, but underwriting standards are still very, very tight, even for non-QM.
Yeah. So the bond market is, somebody's giving somebody else money like a loan. So why do people want to do that? Who's the person that's buying bonds? I mean, I know the person buying CDs is usually grandma because she knows the bank. Yeah. She knows that the SFDIC, insured and stuff. But who are the type people that are buying bonds like mortgage-backed security bonds, those kind of things?
Yeah, great question. So, when you think of like the economy in the big picture, you have savers and you have borrowers, right? And then the savers, in some cases, can be pension funds, right, that are trying to invest capital wisely. Oftentimes, they have what are known as long dated liabilities, meaning they're
Mhm.
going to have to pay out their beneficiaries over a very long period of time. And they're often very focused on safety of principal, very
So
little.
like a teacher's retirement or
Yeah,
something like
teachers'
that?
retirements, firefighter retirements, CalPERS, the largest pension plan in the world in California. So pension plans can be very big buyers. Insurance companies as well, because remember, what do insurance companies do? They take in these premiums and then they invest it to make a return on it. And then when bad things happen, whether it's with your car or your home, they have to pay you back. So they're very focused on safety of principal as well. Actually, U.S. banks are very big buyers of agency RMBS and treasuries. Again, they like safety. They typically can buy those at a higher yield than deposit rates or CD rates or checking account, savings account rates. The last 2 to 3 years, U.S. individuals have become much bigger buyers, particularly of T-bills, which are very short dated, given how high yields were. And just to put it in perspective, there's $7 trillion now in U.S. money market accounts. $7 trillion. So there's never been more cash floating around. And then historically, although this is less of the case today, foreign government entities like the Chinese or the Japanese, Europeans, China, a lot of it was done because they wanted to recirculate money into the U.S. economy to keep their currency rate artificially low. But over time, both the Chinese and the Japanese have become less dominant buyers. China just doesn't run as strong of an economy as they used to. They have a lot of other problems, as you're probably aware. And remember, our economy, the mighty U.S. economy, has grown dramatically over time. Unfortunately, recently we've had a lot of inflation, whereas Japan's economy is kind of stagnated for like 30 years. So their relative importance and ability to purchase treasuries has gone down, and agencies. So hopefully that answers the question, Steve.
So are bonds safe?
Depend-
Are there bonds that aren't safe or riskier, I guess?
Yeah, so at any time you're buying a longer dated bond, the biggest risk, even if there's no credit risk, like the US government, and some would argue US agency bonds are safer than US government debt because not only are they backed by an implicit and explicit guarantee in some cases by the government, but there's also assets behind it, right? Like most mortgages are originated, you know this better than me, Steve, like 50, 60, 70 loan to value. The housing market's done relatively well. Yeah, the global financial crisis was painful, right? We had a dip when interest rates went higher, but it's been relatively strong. Um, so let's assume you don't have credit risk, the risk of the borrower not being able to repay you, but you still have what's known as interest rate risk, or the fancy term is duration. So when you go through periods like we have recently, like 2022, lesser extent this year, as interest rates go higher, that means you have a decline in price for the bond, because those cash flows are less valuable as a new lender or the same lender can now lend at a higher rate. So duration is typically the principal risk. And as you know, Steve, a lot of people had a wake-up call, right? We had this 30, 40-year bond bull market. All yields did was go down, which meant all prices did for bonds went up. And then 2022, you got run over by a steamroller, right? And 23 was, you didn't lose money, but you barely made any. And this year, the most popular bond index out there, which is known as the Bloomberg Barclays Bond Index, is up about 2%. So certainly worse than your CDs have done, and certainly worse than money markets.
So
And that's
tell me
because of
about
duration.
okay. So what about the yield versus the price or whatever, and how they're inverse? I hear that.
Yeah.
What does that mean?
Yeah. So basically, the higher, let's say you lend through a bond, the government money at 4%, right? So it's a 10-year term. You're collecting 4% every quarter, or 4% every year, 1% paid every quarter. And then at the end of the 10 years, you get that interest payment plus the principal back. So what happens is if yields go higher in the market,
What's the yield?
the yield is what it pays. So 4% in this
So
case.
the interest rate rises from
That's correct.
4% to 5%,
That's right. Interest rates go up to 5.
and that's called a yield.
That's called the yield. Your bond that you own becomes less valuable because a current lender or buyer can now buy a new bond at a higher yield.
So I'm getting paid 4%, but I could go buy a new one and get paid 5%.
Exactly. So what happens is prices have to adjust for that and they go down. And to your point about the inversion, the exact opposite can happen, like happened again in the global financial crisis, or really for 40 years, whereas yields dropped. If you're getting paid 4% and the new issue is 3, well, people like 4 more than 3, right? So the price of the bond gets bid up to adjust the yield
So
down.
people will pay me more, or it's more valuable because it's earning a higher interest rate.
Higher interest rate. That's right.
Will they pay me more than, so if I've got $100,000 bond that's paying me 4% and now they're only paying 3, will they pay me more than 100,000 for that 4% bond?
Yes, and that's the concept of duration, the sensitivity to rates. So if you have say a 10%, a 10-year term that is paying 4, right? Quick bond math in my head, you have about 8.5 years of duration, which means if yields drop to 3 in our example, people will pay you 108.50. So 8.5% more than what you paid originally to buy that bond.
And they do that because why?
Because those cash flows are more valuable, right? You're getting a 4% cash flow versus a 3% cash flow, or 3% interest payment versus 4. Yeah,
I got you. So now, so somebody, I lock somebody in. They've got an interest rate of 4%, and now the interest rate, let's say, is 7%. Those people are going to hold on to those 4% as long as they can, right? They're not wanting to refinance to 7%. And so how is that holding up the market in any way? If all those 30-year mortgages there's so many of them at a low rate, how does that affect what the current rate is, or does it?
Particularly for the mortgage market, correct, Steve?
Yeah.
Yeah, so it's really had a hugely profound impact. And if you mind if I pull up a chart really quick, Steve?
Yeah, yeah, go ahead.
Yeah,
Please do.
Got a few slides for your audience here. Give me 1 second. We'll skip this one. This one, again, speaks to how much tighter mortgage underwriting standards have been since the global financial crisis. But if you go back up and look at this chart, what this chart shows is the incentive for people to refinance their mortgage or the disincentive, right? So anytime this chart's above 0, right? If you're a borrower, you have a 5% mortgage and mortgage rates are 4, you have an incentive to refinance. Additionally, there's no disincentive to move, right? Because if you move from your house with 5%, oh, you got a new house at 4, you get a new job, you got to move from Connecticut to Georgia or from New York to Florida, it's game on, right? There's nothing stopping you, right? But what's happened in the last several years, because mortgage rates have gone so much higher, and roughly 80-85% of homeowners have a mortgage 6% below. I think it's like 65%, it's like 5.5 or below. There is no incentive refinance. So refinance activity is just ground to a halt. But I think the knock-on effect that surprised a lot of people, including me, by the way, is that this would become such a disincentive for current homeowners to sell their home and move, or just sell their home and move to a larger house in their neighborhood. And so that's really gummed up the works of the housing market, and it's removed more supply from the market and arguably created an artificial bid, so to speak, where it's not that there's more people bidding, driving activity higher. It's just there's fewer and fewer sellers. And so as there are fewer and fewer sellers and the same amount of buyers, prices adjust and go higher. So this has been really, really profound.
But what's the duration of average? Do you know what a person that gets a 30-year mortgage? I mean, we used to hear that like every 7 years something happens and those mortgages pay off on average about 7 years. Have you heard that? And I'm kind of wondering, what happens when we get 7 or 8 years out from people having a 4% mortgage? Are they going to still hang in there longer?
Yeah. Steve, it's a great question. I think, and not to pull it back to bonds, but there's this concept called extension where bonds get longer and longer. And the same with the duration of home ownership. So it's not like people are going from 7 years to like 20, right? Like that's not happening, but you're seeing it go from 7 to 8, 8.5, 9. But a lot can change between now and then, right? Like we don't expect interest rates to go down in the short term, but over the next 5 years, they certainly could, right? And some of this disincentive goes away. Ultimately, you think about what sets home prices. It's not just mortgage rates, it's income growth, right? And income growth has been relatively strong. I know inflation has been very painful for people, including home price inflation. But if prices stop going up and incomes keep growing, eventually that could take this back from 9 or 10 years back to that 7. But it's certainly been a profound impact, higher mortgage rates on a lot of areas of the housing market.
So let's talk about what you're thinking is going to happen over the next 12 to 24 months with Trump in there and that kind of stuff.
Yeah, so I think if we keep our attention to the bond market, and the way to think about this, everyone, is the U.S. Treasury market typically influences the borrowing rate that you can get a mortgage at through the agency RMBS market. So we're going to start with the Treasury market and then evolve to the agency RMBS market. And look, I think we touched upon this before with Steve, this concept of an inverted yield curve where short end rates, in this case depicted by Fed funds, which is very similar to CD rates at banks, is higher. So 10-year minus Fed funds is a negative number. Very rare in history. It doesn't happen that often. And this has been the longest period of inversion really since the 70s. And the 70s were a train wreck. We had inflation forever. And so what you've seen is the yield curve start to normalize as the Fed has cut, meaning as the Fed cuts rates, the Treasury yield at the 10-year point goes higher. And so, Steve, you probably remember this. Prior to the Fed cutting by 50 basis points on their first cut, the 10-year Treasury yield was 3.62%. So they cut by 50 basis points, then they cut by another 25, and all expectations are for another 25. So front-end rates will be a full 1% lower than they were 3-4 months ago. Guess what? The 10 years at 4.4% now, right? And we'd expect that number to gradually go higher. So the way we see it playing out is the Fed's going to gradually bring the front end to 3.5, and the 10-year, I think, will gradually work its way above 5. And as you can see, like historically, we've had periods where you've had a 4% front end and a 6% 10-year, right? You've had periods where you've had a 4% front end and a 7% 10-year. And there are many arguments, including the size of our deficits, including who's going to be buying all this paper, that would argue for that to even be steeper. So I think when you're in the mortgage business or the residential real estate business, and to your point, it could be perceived as bad, but I think one of the phenomenon that's taken place here is everyone's frozen up because of higher rates, which is slowed down activity. Once people realize that they should stop waiting for mortgage rates to go lower because they're not, then they're just going to get on with their life, right? Like, hey, if you need to move, you need to move. You need to bite the bullet. So unfortunately, we do see mortgage rates going higher. And then to tie it back to the bond market discussion, there's what's known as a spread, which means agency mortgage bonds pay slightly more than U.S. Treasuries. And the main influence on this historically, the last 15 years has been, is the Fed buying agency mortgage bonds or selling them by letting them roll off? And what you see is most of the post-GFC period when the Fed was buying, you had fairly tight mortgage spreads. And when they stopped buying and started effectively selling, you saw mortgage spreads widen dramatically. So, I think once they're done with QT, which is allowing their bond portfolio to shrink, the complete opposite of what they did in the pandemic and the GFC and a lot of the time after the GFC, you're going to see these spreads tighten back in, not to levels like we had here, but certainly tighter than they are today. And that should offset some of the pressure on higher yields on the back end of the curve. So I don't think like mortgage rates are gapping higher or going crazy highs. It's just unrealistic to expect them to go materially lower and stay there.
So I forgot what I was going to ask you, but what about? Oh, I know. What does the deficit? How much does that affect these interest rates?
Yeah, it's a great question. So historically, we've had a lot of benefits in the United States. Now they were hard fought benefits, right? We kept the world out of the hands of the Nazis, and then we won the Cold War. And the U.S. has always been the greatest place to invest, regardless of your political view. Like the U.S. is always the greatest place to invest. And what's happened over time is you could argue our political class has been taking advantage of this, right? This special benefit that we have. And so unfortunately now the size of the Treasury market is as large as our economy. That's only happened during wartime, like World War II in the past.
Wow.
And we're going to be, and to put in perspective, Steve, when you and I were younger men, remember what they used to bash Reagan on? Oh, deficit spender, deficit spender. This guy's a crazy deficit spender. And we had like 25% of our economy was a treasury market. Now the treasury market's as big as our economy. So much, much larger, put in perspective. Remember why Reagan did that? Reagan did that to bankrupt the Soviet Union, right? So it was kind of a good trade, so to speak. But now what we're at is we're going to issue 20 trillion of treasuries, which is like 74% of all the treasuries ever issued, including the pandemic, including World War II, et cetera, the next 10 years, right? And so what that means is every year for the next 10, and this is under the assumption that Trump extends the Tax Cuts and Jobs Act, which we think is a done deal at this point. We're going to issue 7% of all the treasuries that have ever been issued and owned by the public each of the next 10 years. So it's a big number.
And they're issuing it because they need to pay the debt.
Yeah, well, that's another big part of it, Steve. So when you have a lower deficit or a smaller treasury market relative to your economy, it's interest payments aren't that big of a deal, right? Particularly when interest rates are going lower, right? But when you go through a period where interest rates go higher and you have so much more debt to service, just like on your home, if you have a 100 LTV mortgage, it's a lot more expensive to service that debt than a 40 LTV mortgage, right? So it's taking up a larger and larger share of our government budget. In fact, it recently passed the entire budget for our Defense Department, including special outlays, which are kind of off the books. So that's a dangerous place to be in. And look, we don't expect anything dramatic. It's just one way or the other, this has to be addressed. And again, not a political statement. Neither party has any incentive to do it right now.
Yeah. And everybody likes spending money up there.
Who doesn't like spending money, right? Who doesn't like borrowing and spending, right? Borrowing and spending until, if you're a young man coming out of college, you can do like some credit card deferral program or get your balance reduced. And in the treasury market, it could, we're not going to end up like Greece or Portugal, but
so what's needed is for government spending to come down so they don't issue as many treasuries, which will bring the rate down. Is that
well? So
if you were the king, is that what you would do?
Yeah, I would. So only in Washington can you actually spend more money and claim you're spending less, right? I don't know if everyone remembers the most of us, the way we run our house budget, right? It's like, well, I'm making less money, I got to spend less, or I'm not going to spend more, which means I'm spending the same amount. In DC, they have a baseline where like they assume spending's going up. So if they spend less than they planned, they've actually cut spending, which is not how it works in the real world. But so ultimately we need to reduce the growth rate in spending below the growth rate of our nominal GDP or how fast we're growing. And we also need more efficiency in government, right? And that's been a hot political topic. But it's not going to be easy, right? Because most of our outlays go to defense or Social Security or Medicare, Medicaid. No one wants to cut those benefits. But there is hope, right? If we can just grow spending by 1 or 2%, which is the best you can hope from DC, but we can grow our economy by 4 to 5% nominally, real plus inflation. Remember, tax collections come in that way. Then over time, we could gradually bend that deficit down, which to your point would almost certainly lead to lower borrowing rates. So that's a virtuous cycle. What I don't see happening, though, is a dramatic cut in spending. There's just no political will. And in fact, if you actually play this out the longer term, if the Fed can control inflation successfully, which is still a big if, then they could eventually do a quantitative easing program and lean on the bond market to lower rates even further. But that's like 7-10 years out. I think in the short term, we can hope for potentially more government efficiency, a significantly lower growth in spending, and the economy growing at a rate where tax collections continue to go up, which makes the debt more serviceable.
So what's the incentive for the Fed right now to reduce their rate?
Yeah, it's a really curious thing, Steve. So
because we're not there, right? As far as their 2% thing, it actually looks like it's maybe gotten worse a little bit.
Yeah,
but yeah,
so the intellectual justification for what they've done is when the Fed stopped hiking interest rates, everyone kind of looked at it and said, you know what? They're done tightening. Okay. But that's the nominal rate. That doesn't include inflation. The rate that really matters is the real rate, which is the nominal rate. Let's call it 5%. And if inflation's 3, then the real rate's 2. If inflation's 5, the real rate's 0. So what we had over the last year is the Fed funds rate or the front end stayed constant, but inflation kept dropping. So effectively, the real rate was going higher and higher at a time where the U.S. consumer, the U.S. worker, was moving from a position of the most powerful strength they've arguably ever had to a weaker one, because the labor market went from red hot to warm. Excess savings that were built over the pandemic were spent. U.S. savings rates had dropped from 7.3 to 4%. So as the Fed's looking at their calculus, they're saying, geez, the consumer is definitely weakening. They're not weak yet, but they're weakening. The labor market's starting to soften, and real rates, again, nominal rates minus inflation, keep going higher and higher and higher. So what we got to do is we got to take the front end down, the Fed funds rate down to a level that stops that from happening or reverses some.
It's more in line with the inflation rate.
That's right.
That's what they're trying to do. They're trying to get from 5 to down to around 3 or something like that.
Yeah, think 3.5%. And so the other thing that's embedded in there for everyone is that there was a lot of concerns by folks like myself. And maybe we worry too much, right? But some part of our job we're paid to worry is that the Fed made a real bad policy mistake, right? They were completely clueless on inflation, like had no clue what was going on. Inflation's transitory. And, we're sitting there saying like, yeah, maybe April of 21, you can make that argument, but by like August, like there's no way. And then by November, when you admit it's not inflationary, then you don't do anything about it. It's like what is, or not, what is going on? And some of that could have been political cover for the Inflation Reduction Act. It's unclear. But once they got after it, They hiked aggressively. They did QT at like 7 times the pace of the last time. So what we worried about is that they would tighten so much that they would drive the U.S. economy into a ditch just to get the inflation at 2% or below. It's like, please don't make 2 policy mistakes. So they're getting much more comfortable with that like 2.5% to 3% inflation range, and fortunately have not precipitated a recession due to their aggressive policy tightening.
Well, that's off the books. I mean, nobody's talking about a recession now. 6-9 months ago, that was still the fear, right?
Yeah,
I see the optimism now with my customers and people I'm talking to that that's not even part of the conversation anymore.
Thankfully, yeah. So I mean, look,
thankfully,
I think the peak forward recession risk, not instantaneous, meaning like 12 months forward, was October of 22 to like June of 23, because you had basically every recession indicator, inverted yield curve. Then you had bank failures. You had money supply contracting, like all these classic indicators. But by June of 23, August 23, you probably remember the strategy note. I called it Dare to Dream. It was pretty clear that we weren't. And then to your point, as inflation's come down, everyone's been more comfortable with rates being higher. the US is a service consumption economy. It's just much less rate sensitive. So it's very encouraging, even prior to the election outcome, to see much more optimism return. And whatever financial decision you're making, it shouldn't be driven by a fear of an imminent recession. Like that's, and as you know, people make decisions based on fear a lot of times and not on rational decision making.
So are house prices going to go up, or what are they going to do next little bit?
Well, so I think home prices are going to continue to go higher, but at a slower pace, right? So we're going to see, nominal GDP, like, think 4 or 5% type appreciation. But as you know, all real estate's local, right? So like that's national, right? Like in hotter areas of the world of, Georgia, I'm not quite sure where your whole client base is, but Georgia's obviously benefiting from, more of population influx. You think of those numbers in certain parts of Florida, they're almost laughable, but then nationwide, you're think 4, 5, 6%. And again, I don't.
That's good though, right?
Oh yeah, no, that's healthy, right? And again, because if incomes, including inflation, are going up at, let's call it 6 or 7, and home prices are going up by 10, 15, that's unsustainable over time, right? That's unsustainable. Yeah. And we all remember the pain and trauma we went through when the housing bubble imploded. So I think, healthy appreciation, nothing too dramatic. I don't think rates will drop enough to spur meaningful activity. But I think as people get comfortable with higher rates for longer, they're going to stop using that as a reason to not transact, if that makes sense.
Yeah, makes sense to me. I think some people have held in there a little bit and they still have that desire to move, and they're just trying to figure it out. We deal with a lot of first-time home buyers, and we deal with a lot of 50 and 60-year-olds. And so it's two different markets, two totally different markets for us. Mm-hmm. And let's see, I have one more thing I was going to ask you. Oh, lot of stuff going on, conversation about these companies buying houses and renting them out.
Yeah.
Are you seeing that to continue, or will that slow down because the inflation is not as much, or what do you see?
I think so. So there's a lot to unpack there, right? We have underbuilt single family residences in this country for, let's do the math, 15, 17 years now, right? So we just don't have any home supply. And so the main impetus from the institutional investors has been to build and then own and rent multifamily properties, right? That's been a big way we've filled the breach. To your point, a subset of that is single family residences. And I think that's a secular trend, right? The institutionalization of single family rentals. It's not going to move at the same pace it moved from, let's call it 2018 to early 22, because of the correction we had in commercial real estate. So that slowed a lot of the asset raising down. But I think the market share of institutional ownership in the US will continue to grow. You know better than I, you're starting to see political pushback on that, right? But I think that's not going to come in a forceful enough manner to stop this mega trend. And then the last thing I'll say, hopefully deregulatory efforts, you even saw it in New York, of all places. New York's like changed their zoning laws, right? So hopefully more friendly zoning laws can lead to new supply, which is good for transactions, which is good for first-time home buyers. I'm more optimistic on that because I always say, like, when you see folks that pursue a certain type of policy that's counterproductive, and you assume they're never going to change their counterproductive ways, and then they do, like, there's hope, right? There's hope, right? And by the way, just to put a maybe too fine a point on that, San Francisco gets a lot of grief for good reason, but even they have made the turn, right, in terms of policy, right? Which, if you haven't been, it might surprise people, but it's gotten much, much better because their local politicians have really figured it out. Finally, it took a while, but like, you can't have, all this homelessness, lawlessness go on, or you're going to drive, your population and your businesses out. And that's how do you get tax revenue if you don't have businesses and population?
No, but
there's hope there. There's hope everywhere.
It's true. But if I'm a guy with money or a company with money and I go buy single family houses and it's only going up 5%, but I could go invest in mortgage backed securities, paying me 7%, why would I do that?
Well, so remember that the intent of owning the home is then to rent it back, right? So if
Oh
you
yeah, you get
the
okay.
rental
You got
income.
double. You get the rental income plus the
Yeah,
appreciation, which is
exactly.
one of the reasons why people are in real estate first.
That's 100% right. I mean, but
Duh.
the tax benefits aren't bad either, right?
Yeah, that's true. That's true. That's so true. Man, I can't thank you enough, Troy. I really, really appreciate you shedding some light on this for me. And I just think a lot of my friends and customers, we kind of hear those things, but we don't know. And you've kind of dug down on that for us a good bit. So I really, really appreciate it, man. I'm glad to know you. And
Yes,
I got to ask you though. So you
Mhm.
played at MIT. What position did you play?
Yeah, so I played fullback and in a Delaware wing T offense. So for those of you that follow football, you're the featured back. So it was fun. It was, you know, run the ball 30, 40 times, return punts, kickoffs. One of my funnest things to do was the personal protector on the punt team because we used to run fake punts all the time.
Yeah.
You have the guy that's supposed to block the go man, and they have no idea what's going on. Like their backs to you, so you just give your guy a hand signal to run a square out, and it's like one of the easiest pitch and catches.
Boom.
Yeah, it was fun.
Awesome.
And I tell
All
everybody,
right, do you think my Bulldogs, the Georgia Bulldogs, have got a shot at national championship, or who are you pulling for?
no, well, so I'm from Pennsylvania originally, so the fact that Penn State actually made a playoff is like a miracle. Although,
Crazy.
yeah, it was great, because and I know Franklin gets a lot of grief, but it's really hard. You think about what Kirby Smart's done at Georgia and Saban did before that, like taking a program from great to elite is hard, right? It's hard, and it's hard to sustain. But in terms of program strength, obviously Georgia's not the team they've been in the past, but who's better? Maybe Oregon in a good day, maybe Ohio State. I don't know. I just it's hard to beat the Bulldogs when they're rolling. But it's a lot of parity, right? There's a lot of parity, but they have as good a chance as anybody. And I think last I checked the odds, they're still favored. You might know better than me, Steve, but it's not like they're a dramatic favorite.
Hell, I'm pulling for them either way.
Oh yeah, man, come on.
I love it.
Great program. Well,
All
hey,
right.
it's a pleasure. Happy holidays.
Thank you.
Merry Christmas to everyone, and look forward to staying in touch, Steve.
You're awesome, buddy.
Talk to
Thank
soon.
you.
Bye.